2021 was the year of the Great Rebound. As vaccines rolled out and government stimulus peaked, the global economy roared back. It was a pretty good time to be an investor. For much of the year, risk assets surged ahead, extending their recovery from 2020 lows. Our advice going into 2021 was to position your portfolio for the rebound that we expected. But after such a strong performance for the economy and markets, we're now hearing widespread worries about what comes next. Can the economic recovery survive reduced stimulus? Is the global supply chain broken? Will shortages persist? Will higher inflation become a problem? Do lofty valuations in areas like technology mean lackluster returns ahead? I'm David Balin, Chief Investment Officer for Citi Global Wealth, and I'm here to answer these and other vital questions. Welcome to Outlook 2022, your investment guide to the coming year and beyond. After 2021's powerful growth spurt, we acknowledge that the strongest phase of the expansion is now probably behind us. Nevertheless, we're still positive about the global economy for 2022 and beyond. After the pandemic boom, we expect growth to moderate, but also to endure. COVID will become a manageable disease. Ongoing vaccinations will enable a broadening recovery in services, with international tourism making a comeback. At the same time, manufacturing should remain strong, driven by businesses rebuilding their inventories. As services rebound and inventories rebuild, the demand for many goods will normalize, and this will allow a return to a normal economy, one where the supply chain issues and shortages that we now hear of become a thing of the past. We expect inflation to abate too. So what does normal mean for you and your portfolio in 2022? A normal economy means more moderate market returns. Annual growth over the next 2 years may average 8%. That may not seem like a lot after a 45% gain in earnings, but it is positive and above average growth. For global equities, earnings growth may point to mid to high single-digit returns in 2022. But for global fixed income investors, we expect another difficult year, but not as bad as 2021. Overall, bonds might deliver just 0 to 1%, which would be a negative rate of return after inflation. In the US, for example, inflation might still come in at 3% for the year. This maturing bull market may sound a bit boring, but think about it this way. If you made a profit by following our counsel in 2020 and 2021, you can now expect a consolidation in your portfolio. Valuations can become less stretched in an environment that we expect. As we enter a more normal phase in the economy, we need to think about what sectors, regions, and attributes will be more profitable than others. A year ago, our advice about emerging markets, small cap equities, and beaten down cyclicals allowed investors to earn well above average returns. Since then, we've shifted allocations toward less cyclical, typically less leveraged investments, such as global healthcare equities. For 2022 and beyond, we emphasize having exposure to what we call long-term leaders. These are equities in high-quality companies in promising areas that we believe could deliver superior earnings growth in the long run. Our analysis shows that market and industry leaders deliver strong returns with lower volatility over time. Leaders we favor include dividend growers, or equities in companies with long records of consistent dividend growth. These dividends can take the place of bonds for a portion of your portfolio. We want our clients to avoid negative real interest rates that make cash a guaranteed way to lose buying power. We want you to beat the cash thief. Next, we make the case for exposure to unstoppable trends that are transforming the world around us. These include cybersecurity, 5G and related technologies, fintech, digitization, and of course, the rise of the Asian region more broadly. We believe these forces could help reshape business and everyday life as well as your portfolio. The last year or two has been difficult personally for many of us and our families. But interestingly, these have been good times for those who kept their portfolios fully invested and well-positioned. As the recovery endures and the bull market matures, we reiterate the importance of being fully invested and not market timing. Almost everyone who tries to time when the markets will rise and fall fails to do so. Consistency as an investor means staying invested but not staying still. Portfolios that adapt to the times but remain invested are the wisest for the long term. Discover more of the opportunities that we see by reading our Outlook 2022 publication. Then take action in your portfolio with the strategies that we recommend for you. Get ready for 2022 and beyond. Let Citi Global Wealth be your guide and counselor.